let's take a look at some of the market action that we are seeing. As I mentioned, we are seeing some mixed picture on the S&P 500. Once again, real estate, one of the worst performing sectors. And no matter how you slice it, even though leadership has changed amidst the S&P 500, real estate pretty consistently has been an underperformer. But it's a sector our next guest is recommending investors take a look at. David Sekera is the chief U.S. market strategist for Morningstar, and he joins us now. David, thank you so much for being with us. Real estate continues to be the sector that really isn't getting out of bed the way, another bond proxy sector like utilities is. It's recently perked up. Still in the penalty box, it seems.
Yeah, I mean, real estate is still got to be the most hated asset class, on Wall Street right now. And personally, I'd still steer clear of urban office space. I still think that there is a high potential of some downward valuation adjustments there. But we see a lot of value in some of the more defensive areas in real estate. I think healthcare, triple net lease providers, self-storage. And when I look at some of the stocks, the intrinsic valuations right now, we believe provide a very large margin of safety. So, for example, in the healthcare sector, we like Ventas. That's a 5-star rated stock. Trades at a 33% discount to our fair value, currently pays a 3.8% dividend yield. Among the triple net lease providers is Realty Income, another 5-star rated stock at a 28% discount, nice healthy 5.6% dividend yield. And then for the self-storage, I'd point to Public Storage. That's a 4-star rated stock at a 13% discount and a 4.4% dividend yield.
So, I mean, you are no stranger to going against the grain and looking for ideas that might not have momentum in front of you, but sometimes that can pay off. I remember a couple of months ago, you were talking to me about Newmont or some of these gold miners. You couldn't give that stock away. Newmont has bounced significantly. It's up 40% from those lows in February. So these things can happen pretty quickly.
Yeah, and you know what? As far as the gold stocks go, I still think there's a lot of value there. Now, I find it really interesting. We actually have a pretty bearish view on the long-term price of gold, in and of itself. So our long-term outlook there is for gold to actually fall down to 1,780 per ounce in the long term. But in our model, we are using pretty much the spot price of gold for the next 2 years and then decrease it towards that long-term average. But yet, even with those bearish underlying assumptions, we still find the gold miners to be very undervalued. In fact, Newmont Mining, at a $51 fair value, is still trading at a 19% discount. That's a stock we rate with 4 stars.
So it's interesting because if you think about this positioning, real estate, gold, these are defensive. These are maybe preparing for some sort of slowdown. Whereas if people are weaning themselves maybe off tech, which I know that you've been recommending investors do, they've been preferred to go into more cyclical areas like industrials.
Yeah, unfortunately, I think industrials are overvalued. It's one of the more overvalued sectors according to our valuations. Specifically, when I look at the industrials, the transportation names, we think are pricing in, just, too much robustness for too long, specifically the airlines and the trucking industry. So among the airlines, Southwest Airlines is a 2-star rated stock, trades at a 44% premium to our fair value. And XPO is a logistics company, again, a 2-star rated stock at a 35% premium. Granted, they've had great growth. They've been able to pick up a lot of business in the short term following the bankruptcy of Yellow Freight last year, but we think the market's pricing in too much growth for too long there.
I wonder if you're how you feel about a recently out of favor sector, which is a lot of these that touch the consumer. I'm thinking about, a Starbucks, a McDonald's, even Tyson Foods with its latest quarter disappointing. Is there a buy the dip opportunity there, or is it maybe a warning sign when these consumer stocks start to stumble?
Well, it's really going to be idiosyncratic, to the individual stock. So Starbucks, I think our analyst was shocked by the results that came out, just how much they missed, expectations there. McDonald's results were pretty weak as well. Tyson, another company that's talking about, some of the consumers, really kind of starting to break here. So I think it's going to be idiosyncratic on valuation, but I do think from more of a macro point of view, between Starbucks, McDonald's, and Tyson, it is a bit of a canary in the coal mine that I think the compound impact of inflation over the past 2 years is really starting to pinch, the consumer. We know the low-end consumer has been, under pressure for a while. It seems like that's starting to move more into the middle-income consumer as well. Now, initially, people were able to offset these higher prices. We had, the excess savings from the pandemic. That's been used up. We then are eating into the savings rate. I think that's probably getting to be, near the end as well. So a lot of consumers pulling back on discretionary spending, especially those areas that we consider to be indulgent.